Welcome to my channel. I'm the cover call guy, and my portfolio currently yields about $72,000 a year, about $6,000 a month, about $1,400 a week, and about $200 a day. My goal is to create a $120,000 per year passive income portfolio using only cover call ETFs. Legal disclaimer before we start: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. Remember, I am just some random idiot you found online and I could be completely wrong. Now, with that out the way, we're going to start on today's video on the expense ratio war series. This seems like it was a very popular request and it was a few of our people's favorites. So, if you want to continue this series, let me know. Subscribers, let me know. Comment which fund do you want to see next. And we're going to get it started. We're going to do a Sherlock Holmes forensic audit. Are you overpaying for Roundhill Investments? I did an analysis of 44 ETFs. Let's get started. Give me back my money, right? My goal here for you is I am analyzing Roundhill Investments 44 fund lined up to answer your critical question, right? Are you overpaying? To ensure fairness for you, if you own these ETF or stocks, I'm moving beyond a simple fee comparison, right? The approach here is I'm going to be using a multi-factor value framework to gauge if the expense ratio you pay is justified by utility for your portfolio, because everyone's lifestyle is different, the execution of the complexity, because the more complex, the more you might not want to be like, I'm going to have to keep an eye on this, right? Because if you have to watch it every hour, every day, it might not be worth it, right? Unless you're a trader. For the most part, we are not traders here, right? We want to buy, get paid, have some type of sleep well at night type of energy here. Structural advantages for you. All right, the new value verdict criteria that we'll be using and going forward is the strategy and complexity. Like I said, in the fund, is the fund executing a strategy like 0-day time expiration options that is too difficult for tax inefficient for you to replicate manually, right? Because at the end of the day, could you do this? If you can't, then it might be too hard for you to understand, right? You got to understand what you own, right? Otherwise, if you don't understand what you own, then you might be getting ripped off, or you might be getting kind of screwed. Your total return. Look beyond the price. Does the total return, the NAV growth plus reinvested income, justify the fee you pay, even if the NAV is flat? Because we always have to look for, when it comes to cover call ETFs, income investing, we have to look beyond the price, the total return, which is the NAV growth plus reinvested income. Risk and tax efficiency. Does it offer defensive benefits or tax alpha that offsets the headline fee for you? Verdict categories, right? We'll have high utility, fair value, the fee you pay or justified by unique access, right? Tax advantages or complex execution delivering strong returns. Specialized / income focused, right? Moderate fees are justified for your specific income needs if you accept structural trade-offs like capped upside. And then structural mismatch / overpaying. You are paying high fees for generic exposure or strategies where structural drags erode your shareholder value, right? Then you basically at that point you just rather own the underlying, forget about the income. There's a better chance of you making money with that underlying waiting for growth. So that's what it just means, right? It means overpaying, get rid of it. Not for us, not for you. Covered, called, and income suit, the risk managed yield. So before we get started, I just want to give a little general description. All right, the critique shift is that while these funds carry high expense ratios, typically 0.95 plus, you are not necessarily overpaying. You need to view this as an outsourced execution service, right? You are paying someone else to execute these cover call strategies for you. Yes, you can do this yourself, right? But you'd face constant monitoring, trading spreads, and tax headaches. So when people make that argument, right, saying, "Oh, you could just do it yourself." Right, but I'm too lazy to do it myself. I want to pay somebody else a little fee to hopefully they execute it for me while I'm on the beach sipping champagne somewhere in, somewhere warm where it's Southeast Asia, um, Japan, Europe, South America. I don't want to have to do it myself, right? I want to be worry free. I'm on a plane somewhere, flying to my next vacation destination. So when someone makes the argument, "Oh, just do it yourself," no, I'm paying someone because I'm too lazy and I want to be worry free. So this is the counter argument. All right, but first one we do is Roundhill Magnificent Seven cover called Maggie. My verdict here is that free. It's fair value slash. You do have to have caution for it. Why? Because if you are in the assumption phase, accumulation phase, right, it's fair value. You have a chance to buy things at a lower cost and dollar cost average because this is not just for Maggie, but for all cover call ETFs, including Roundhill, um, JP Morgan, Yield Max, uh, Tap Alpha, Granite, Neos, Goldman. And what else am I missing here? I know I'm missing a few. Curve. What else am I missing here, guys? All right, every single cover call ETF has been pretty much released during the crazy bull run, which is why I put fair value slash caution. All right, it's fair value because for someone like me, it may be you, we are in the accumulation phase. We are building up this position. So at times when there's a drawdown, we can dollar cost average, right? Because we are in a one of the strongest bull market we have ever seen, ever seen. It has been going nowhere but up, 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 right? And most of these ETFs has been released during this time. And I want to put caution is for those who are actually fully built out in this position, you might have bought at a time where the share price, I think the highest the share prices was like it reached like 57 or $58 or something like that, maybe even higher. I think I've seen it around 57, 58, $59. If you bought around there, then I say have caution, right? Because if you're fully built out on this and you're receiving paycheck and now it has gone down to like 54, 55, $53 because the market has going down is cooling down, you might be like, "Oh, I'm down on my NAV, right? Or I'm down on my total return." So you have to have some caution and think, "All right, should I just kind of lower my cost based average here and give myself that breathing room?" Right? That's it's totally up to you if you are already in your consumption phase, where you're using this to live off of. Right? The expense ratio for this is 0.99%. The strategy here is long Mag 7 stock plus short call options. Why this verdict is for you? Why do I have it for fair value slash caution? Well, the complexity, right? Selling cover call on 7 specific stock weekly is operationally intensive for you to have to do alone. And so that's why when they're doing it on 7 specific stocks, it is a very complex because they have to manage it where they don't want to destroy the NAV and they have to pay out weekly. Your income, the yield is about 20% right now, compensates for you for capped upside, and the NAV drift. Risk mitigation, option premiums buffer your downside during tech corrections. Conclusion, 0.99% is fair service fee for outsourcing this volatility harvesting. All right, Innovation 100 DTE, cover called QDTE. My verdict, high utility here. Expense ratio is 0.95%. Strategy uses synthetic long NASDAQ 100 plus short 0 DTE calls. Why this verdict is for you? Your tax alpha, it uses section 1256 contract, which is a 60-40 split. If you trade this manually, you pay 100% short-term gains tax. The tax saving exceed the fee. Complexity, execution of daily option is difficult for you to replicate efficiently because I'm assuming we are the most general. This video is going to be like we're assuming we're the general retail trader, right? We don't exactly have a whole team that has been doing this for 10, 20, 30, 40 years. So complexity here is going to be quite difficult. The conclusion for me is that the fee buys you a distinct tax alpha unavailable elsewhere. So my verdict, this one is good, right? It's high utility. You have to know how to use this QDTE kind of to fit around your needs. 3 and 4, it's SP 500 and the Russell 200, 2000 DTE. I'm gonna say XDTE and RDTE is high utility. The fee for both of them is 0.95. My logic here for XDTE is that it shares the same tax alpha advantage as QDTE. It gives you a lower beta income stream of 17% compared to Nasdaq, acting as a stable core holding. And then RTTE, my logic here is small cap volatility is naturally high, creating rich premiums for you. It is the only zero DTE fund currently growing principal at around almost 1.59% for the NAV while paying you a high yield. So these two, thumbs up. Crypto and cover call strategy, right? I'm going to say here is fair value and caution. Again, YBTC for Bitcoin. Criteria, crypto volatility is extreme. Managing Bitcoin options required specialized asset outcome. It helps you convert volatility to cash efficiently. The plus 48% total return justifies the cost. But there is some caution to it because, again, it is a very volatile speculative asset. And again, the same for ETH, fair value, caution, YETH, criteria, again, same structural advantage as YPTC. The outcome, while ETH has lagged the structure execute correctly for you, the fee is standard. Core and efficiency suits the loss leaders, broad market access at rock bottom prices. My verdict here is not overpaying. These are your absolute best value if you want the growth. Roundhill Magnificent 7 ETF MAGs. My verdict here, not overpaying. Absolutely amazing growth, pair growth ETF. Expense ratio is 0.29%. It is a little bit high compared to straight passive. The strategy here is equal weight rebalancing of the 7 largest stocks, the MAG 7. Utility. If you attempt to replicate this manually, you pay bid-ask spread and trigger taxable events quarterly. Cost efficiency, 0.29% is likely cheaper than a slippage and time cost you would incur manually. And of course, the complexity solves the odd lot problem for you, right? So this is absolutely a pure growth play, very, very cheap. The expense ratio you're paying is worth it. Tax efficiency and cash management. XDIV, it pays no dividend, right? My verdict here is excellent, not overpaying. It is a pure growth play. My criteria, your tax efficiency, standard S&P funds force you to take a 1.5 taxable yield annually. High earners lose about 0.36% of value to taxes, which is a tax drag. The outcome here, by avoiding dividends, XDIV saves you that tax bill. The savings exceed the fee, right? So this is a pure growth play. And then the week, which is a T-bill, my verdict here is fair. Criteria, utility, right? Instead of a high yield savings, just put your money in week and then you can use it as a dry powder. Provides you weekly liquidity for cash management. Outcome 0.19% is competitive. You aren't overpaying for cash access, right? So you're earning interest weekly here. This is for utility, right? Like I said, criteria here is utility. You want to put your dry powder in a weekly paying T-bill. The WeeklyPay suits the leverage income 1.2x. My verdict here is that it varies what requires active management, right? Here's the nuance you need to watch. These funds are often criticized for NAV erosion. However, if you are an income investor spending the distribution, the key metric is whether the total return sustains your payout while destroying the asset base. Top performers. We have Plantier, right? These funds use leverage to amplify gains, easily covering the 0.99 fee you pay. PLTY, total return is plus 63%. Total return, the leverage captures the parabolic move for you, creating alpha for exceeding fee drag. Verdict, excellent. Hood, HOOW, return, you basically doubled your money, right? 100 plus 100 and almost 10% total return. Massive breakout. The fee is irrelevant to you compared to these gains. Verdict, excellent. Google, GOOW, plus 33%. Sustainability, the strong trend compensates you for the 0.99 cost. My verdict here is fair. Caution because, again, Google is a it could slow down at any time, right? So they've been riding the wave and they've been shooting up. So fair caution is you have to be careful here depending on when you got in and out. NVIDIA, NVDW plus 35%. My risk here is slight NAV erosion at negative 3%, but high total return justifies it for your income needs. I'm gonna say fair caution depending on when you got in and out, right? So just be careful here that and understand the way you need to handle these single stock. The volatility trap, right? NAV erosion risk, right? Here, the 0.99 fee plus volatility drag plus distribution exceeds the stock's growth. Micro strategy, MSTW. Why this doesn't pass the winner test for you? Diversification failure. Unlike WPay, this has no other assets to buffer the drop. You bear 100% of the volatility decay at about minus almost 30%. My verdict here, you're overpaying. Coinbase, COIW, sustainability, about negative 13% on NAV erosion. You are paying a 0.99% fee to watch your principal erode. My verdict here, caution. I mean, if you want to get in for the hype and ride it, just know when to get in and get out. Apple, AAPW, structural inefficiency. Apple itself is a low volatility stock. Paying 0.99% for leverage here creates drag, right? Alpha for you. You're overpaying. Just buy the underlying. What is the point of doing this for Apple? There's no point, right? Apple doesn't move like that for the most part. Microsoft, MSFW, structural inefficiency. Same as Apple, the fee consumes almost all the upside for you. My verdict here, overpaying. And then the rest of the suit, right? Tactical tools, big tech, Amazon, um, METW, NFLW, structural mismatch. 0.99 fee is too high for mature stocks. The cost of leverage eats your gain in sideways market. My verdict here is you're overpaying for these three big tech. Defensive, Costco, and Berkshire. Mathematical inefficiency here. All right. Levering low volatility defensive stock at a 1% fee is structurally inefficient for you. My verdict here, overpaying. Just go ahead and buy the stock. You have a better chance of it going up. Costco has been going up, up, up. Berkshire, of course, right? Buffett. You might as well just buy the underlying. The growth itself will outpace what you're trying to get paid here. The funds of fund WPay, performance check here. Roughly plus 10% since inception. Yes, it has gone down depending on your reinvestment. It's performing well for you due to winners. My verdict here is fair slash caution, right? Is it a tactical play? Structural erosion risk remains, but diversification is working for you right now. All right. So WPay is really depending on when you got in and out. All right. So if you're buying at a time where I think it's at $47 or 46 or 45, right? It might be like, oh well, this might be the time to get in and start nibbling in on it. So it's a fair slash caution play. Thematic and legacy funds, right? Niche sector bets. My verdict here is that where you are likely overpaying for these, right? So weed, cannabis, promo value. The logic here, the fee is zero. Way you literally cannot overpay is the cheapest way for you to access difficult sectors. Uranium, it might be a good value play because of what this administration, the Trump administration, is trying to push. They're trying to expand on, the bring America back, right? To start building factories on all this national defense stuff. So there is a play here. The logic, 0.45 fee, access to physical uranium miners is scarce. Fees reasonable for your niche utility. So it depends how you want to play this. And MAGY, this is China. Fear slash caution. My logic here is 0.59 fee. Competitive pricing for emerging markets exposure, which is harder for you to trade. And I say caution here because it is the Chinese market and the way they operate their market. Literally, one guy can say, "Nope, this is done. This is out," and that's it. You lose everything. So it's not like they have a appeal process there for those who trade the um the Chinese market, right? Like Alibaba, all right. One guy can literally go, you know what, Alibaba, I don't, it's I don't like it anymore. And that one guy is Xi Jinping, right? If he says something about Alibaba, then there goes Alibaba. And that's it. There's no what ifs. There's no appeal. One guy makes that decisions, and it could affect the entire Chinese market. The high fee slash low utility group, metaverse, value of relative value. QQ offers you better tax exposure for 0.20%. My verdict here is overpaying. Betting bets cost is 0.775%, is high for a sector that has cooled off for you right now. Overpaying. These are more specific time to get in. Gaming, which is nerd performance, consistent underperformer versus broader tech. My verdict: overpaying. Gen I, which is chat, redundancy, expensive 0.75% compared to MAG's 0.29%. Overpaying. And then weight loss. And this is the Ozempic one, I think OZEM. It's a utility unique basket, right? Has LLY, NVO. Hard for you to isolate elsewhere. I'm gonna say it's a fair slash caution one. It just depends on how you want to play utility around your portfolio. Other funds, Mag X at 2x, Mag 7, fair caution. My logic here is standard leverage cost at 0.95% for daily 2x. Hard for you to replicate without margin. XPay, right? Fair caution. My logic here is 0.49% fee. Cheaper for you than 0 DTE funds if you want a managed payout policy. I say fair caution here, depending on when you get in and out. Um, it can work out for you, right? And then TSYL, the treasuries, I'm gonna say you're overpaying. The logic here is 0.99 fee, and you're paying 1% to lever treasuries. Is mathematically inefficient for you versus TLT options. This one, I don't know why people would want to buy this. I mean, I guess there's a market for this, is why they created it, but absolutely overpaying here, a 0.99 fee. You're definitely getting ripped off here. Right, my final conclusion, right? The overpaying matrix, right? So how I determine this, my verdict here using best value, your portfolio core slash tax aware funds you should buy, right? Mags, XDIV, Weeks, RDTE, UX. My rationale here is the lowest fee in class, unique tax utility, or proven growth for you. And then strategic income, your portfolio is income slash cash flow, right? Funds you should buy: MAGY, QDTE, XDTE, YBTC, NVDW. Fees are high at 0.95 plus, but justified by total return, risk mitigation, and tax alpha for you. All right, it is in the yellow and it has caution because, again, but these are a little bit more strictly timing, right? These here, for the most part, you can buy at any goddamn price and you'll be good, right? For the most part, you'll be good. These are more timing wise, which is why I put strategic income and why my previous slide says slash caution. These are more depending on where you're at in life, right? If you're in accumulation phase like I am, then it might be okay. I'm gonna just dollar cost average, right? I'm okay with that. I'm building on my portfolio. I have another 120 grand for Maggie for me to dollar cost average into. I'm okay with that. If it drops $3, you know what? My dollar cost average price will be $3 less. So just really depends on how you play this. And then of course overpaying, passive slash long term, mostly weekly pay slash thematic share plays, right? Fees erode your principal faster than the underlying asset grows. Better alternative exists. Again, some of the overpaying could end up being in the yellow. It's just right now the market is hammering these um the overpaying one that I have, right? So it's has not been doing well, or it's better for you just own the underlying or go somewhere else. My verdict: Roundhill is not ripping you off. They are selling you convenience and complexity, right? Buy Mags, you get a bargain. Buy Maggie slash QDTE, you pay for a premium service. You're paying for that service where they're paying you weekly and handling all of your cover cost, the strike price, and trying to handle the NAV price with it. If you want to buy forever NVDW, you are overpaying, right? These are, you might as well buy the underlying at this point and say, you know what, this section of my portfolio will be growth for these underlyings. Did you find value in this? Don't miss the next forensic audit. Let me know which fund you want me to cover next. Give me ideas. I did Max, but I haven't done the full Max. I'm gonna let Max go ahead and change up the strategy because they are doing the reverse split, and they are, I believe, they are trying to change up the strategy in some of their stocks. So I'm gonna go ahead and let them do that and give them some time to see how it, at least 2 3 months to see how the stock performs with a new strategy. I don't think it's fair to just judge these stocks right away. We have to give it some time. If I'm missing anything from Roundhill, let me know too. If you think you disagree or agree, let me know because again, these are just how I'm basing it on my criteria, and everybody's life choices and life preference and life goals and where you're at in life is different. So some might be overpaying, but for you, it's fair value. Some might be fair value to you, but it might be excellent or a buy now. Thanks for watching, guys. Again, let me know which fund you want me to do next. Is it T Alpha or Goldman, GP Morgan, Neos? Let me know. Leave in a comment, like, subscribe, comment. Thanks for watching. Catch you guys in the next. Stay tuned.